Hello and welcome. Thanks for watching. My name is Thorsten. I'm the founder of Dividend Stocks Cash. It's all about long-term profit growth here to help you benefit from capital gains and growing dividends as well. Sometimes since I laid my last video here on this channel, I'm really sorry, but I wasn't lazy. I did a lot on my German website, and I also continued developing or evolving this screener, this website, and we are going to do some valuation of very popular stocks, and I'll show you how to get an idea if the stock is currently undervalued, overvalued, or maybe fairly valued. We take a look at Apple at 3M, and why not Amazon. Amazon's no dividend stock, I know, but we can also screen and evaluate Amazon. So let's go. This website is purely dedicated to high quality stocks, and high quality stocks can be valued using historic or applying historic multiples, and I show you how this works. We have this valuation tab here, and let's get rid of the pre-calculated results to better explain you how this works. I will show you the fundamentals first here of Apple, and our first task is to find out which time frame is characteristic for the company today. So we have Apple has a price earnings of about 18, a price to cash flow about 14, dividend yield of 1.5%. We apply price earnings, price cash flow, and the dividend, well, the fair value calculations. So there are 3 fair value calculations, and they are based on earnings, cash flows, operating cash flows, and dividends as well. And always works by calculating an average price earnings, an average price cash flow, and an average dividend yield, and then applying it to the current fundamentals, to the current earnings, current operating cash flow, current dividend yield, and then we get an idea if the stock is over or undervalued. Let's find out the time frame which is characteristic for Apple today. As I said, the price earnings is 18, and if we look here at the beginning of the millennium, Apple posted even losses and then very high price earnings, more than 100. They're in parentheses because there is an algorithm, and it detects outliers so that they don't invalidate your calculation, your average calculation results. In 2004, we had a price earnings of about 14, which is still much higher than the other price earnings. And then we have 25, 29, which is still higher, and then we have 26, 24, and we have no price earnings above 20 since 2009, since the financial crisis. That's why I'd say we start maybe here with 2009. Let's have a look if it's characteristic for the price operating cash flow. It's 15, 10, 11 in 2009. Today it's about 14, but it was as low as 8 in 2013. So I think it's okay. We use this time frame here when Apple didn't start paying dividends yet, but that's not a problem. Okay, we have chosen the time frame to do the fair value calculation, and now we show the historic prices of the stock, and then comes the best part. We add our calculated fair values based on earnings. You see it here, and then you see that the historic stock price respects the fair value calculation. So sometimes Apple was undervalued, was the case in 2013, was the case in May, April 2016, and sometimes it was highly overvalued, which was the case in August 2018, for example. The same for the fair value based on cash flows, and also, why not, for the fair value based on dividends. And then let's zoom in. And we see here that in 2018, the stock was clearly overvalued. And then we have this price drop. And then the stock was about fairly valued. It was overvalued once again, back to fair valuation. And then now today we are here. Stock price $230. but the fair value is about 176 to 164 US dollar, depending on the fair value based on dividends. It's also the same as the fair value based on earnings, which means the stock is currently overvalued, Apple. And thanks to growing profits, cash flows, dividends, and earnings, we have growing fair values as well. But they are still, the fair values in 2021 are about the same as the current stock price. So you might expect, if you want to get an idea about the yield in the next year or at the end of the next business year, which is September 2020, and you might think that your yield might be somewhere here between 190 and 176 US dollar might be the stock price, and if it drops to the fair value, and then it means that your capital losses or your book losses would be 10%. You can also add valuation lines to get an even better or more options how to choose your expected total returns, because they include dividends as well, and you might opt for a value between the fair value, so an average of the fair values if you want. So that's the fair value of calculation of Apple, which is clearly overvalued right now, with these or based on these on the current multiples, price earnings 18, price to cash flow 14, and the historic averages were price earnings 15 instead of 18 and about 11 instead of 14. And the dividend yield was 1.7 historic dividend yield, and now we only get 1.4%. Let's do another stock, 3M, and let's get rid of the automatically calculated fair values. We derive them by ourselves, and here you see 3M, all the fundamentals starting in 2000. And once again, we need to find the time frame which is characteristic for the company today. For 3M, it's really easy, because price earnings in 2001 they were 31, which is really above all other price earnings. But 24 already is a price earning, is also above all price earnings above 20. Here it was 24 in 2017, but maybe a more characteristic, I would say, let's start with maybe 2005, because it's 23 or higher price earnings, they weren't characteristic for the last years. So let's start with 96, and then we have a price to cash flow 40.5. Now we also have 40.5. Oh, that's nice. And this is a time frame we use. And then let's show the historic stock price here, and then the fair value based on earnings. And then you see that the 3M was undervalued for a long time. Then it turned into overvaluation, which culminated in January 2018, and then we had this price drop. Fair value based on operating cash flows, it's roughly the same, and fair value based on dividends. It looks a little bit strange maybe, because starting here the fair value dividend increase, so the company suddenly based on dividends gets much more valuable. Why? Because the dividend policy of 3M was changed. You can see it here. 3M increased its dividends starting in 2013 much more aggressively than they did before, and because of this, dividend yield increased, and the company based on the dividends became more valuable. That's in other words, this time frame is not characteristic for the dividends. So we shouldn't consider the fair value dividend. If you want to consider the fair value dividend, then we should maybe opt for a shorter time frame, starting when the dividend, after the change of the dividend policy. But we still have these two fair value calculations, and it should be enough to see that the stock right now, let's zoom in, is about fairly valued. So it was clearly overvalued here, and then came this price drop. You see it here. The fair values ranged from 145 to 160 US dollar about when the stock price was actually 250 US dollar. And now the stock price came here to 164 US dollar, and the fair value based on operating cash flow is 160 US dollar, very close to the stock price. Based on earnings, it's 144 US dollar, so its stock is even overvalued. But according to estimates, the fundamentals will recover, and based on the business estimates of the next business year, not of the current business year, the stock would be undervalued already. So what to expect in the short run? If the stock market gets in bad conditions, or maybe the stock price might still decline. In the long run, if the estimates come true, then we might expect capital gains. And if we base our expected yield here on the estimates of the next business year, 2021, then we have fair values between 188 and 190 US dollar. And if we are a little bit more conservative and we take this valuation line, then you see that the annual yield is to expected annual yield is about 9%, which includes capital gains and dividends. And the total yield would be 21.8% from 164 US dollar to 186 US dollar. So 3M is a nice buy. It's a solid dividend stock, and you might expect some capital gains as well, and dividends about 3.5%, which is really nice. So I suggest last stock to take a look is Amazon. Here it comes. And maybe get rid of everything which was predefined. So add the fundamentals here, dividends we don't need. And Amazon is a little bit harder to evaluate or to find the fair value, but it's not impossible either. You see here the earnings for a long time are really sluggish. There was no earnings growth because it wasn't the priority of Amazon, as you might know. But the operating cash flow, well, let's look at the price earnings first. You see the price earnings were 470 in 2003, and 30, 50, 80, 60, about 50, 40, 55, 140, negative here, 500, 380, 140, 210. So completely disarray. So it makes no sense to calculate an average price earnings here. But the price to cash flow, which is currently about 20, and you see in the latest years, 26, about 20, 90, 22, 25, 24, 23, 18, 11 only in 2009 during the financial crisis, then 18, 20, 22, 23, 30, 32, which is above everything we've seen here. So if you want to find the characteristic time frame for Amazon based on operating cash flows, we could start in as early as 2005 here. Here we go. And the earnings, we must get rid of them. We can't use them. It remains the operating cash flow, and now we have the stock price here. Now let's have a look at the fair value based on the cash flow, and this is it. And here you see that the stock price respected this fair value, and then starting in spring 2017, Amazon became overvalued based on the operating cash flow fair value. And but today, let's zoom in a little bit. But today the stock is fairly valued. Amazon did not lose as much as, for example, 3M. They also lost some. They lost about 25% even from September 2018 to December 2018. But in general, in the last 1.5 years, about the stock went sideways. But that was enough for Amazon to for the fair values to catch up, because thanks to growing operating cash flows. So today the stock seems to be about fairly valued. If we use the fair value of the current business year, would be $1,882 and the current stock price is $1,833. So it's slightly undervalued from this point of view. What to expect, and if we have the valuation lines here, or you can just connect the current stock price with the stock price which we calculated the fair value, and then you see here the fair value would be $2,800. It's about $1,000 more than the current stock price, which would mean that we have kept an annual yield of slightly above 20%. Not bad. So maybe one more. Let's have a look at AT&T, which is also a very popular dividend stock. And let's get rid of the results and first concentrate on the fundamentals here. And then we see that we have very reliable dividend payments. That's already nice. But we see that the reported earnings weren't very reliable, and there was also no real earnings increase in the last decades. Went sideways. There was just a slight increase in operating cash flow, but in the last decade it also went sideways. So let's try to find characteristic multiples, the time frame to apply. In 2001, price earnings were 21. Wow. Today's price earnings is 14, and the price to cash flow is about 5.5. And we see that in 2011 there was a very high PE ratio of 44, but it's marked as an outlier. 27, which is also very high. But then we have 15, 12, 8. We could start with 2002 even, where the price earnings was about 14 and the price to cash flow was below 7. Let's start here. If I can, I prefer longer time frames, valuation time frames, because they give me a better idea, because I can compare the historic stock price with the fair values which were calculated for a longer time. And the current dividend yield is about how much? 5.6%. Yeah, exactly 5.6%. And the historic dividend was 5.3%, so it's slightly undervalued, the stock according to dividends. And here we see the average multiples which were calculated, and I can already see that the stock regarding these multiples slightly overvalued. Sorry. So let's add the stock price here, and you see constant up and down. That's today's stock price. Let's add the calculated fair values, all of them, and then you see that the fair values calculated on the operating on the earnings are a little bit bumpy. Why? Because the earnings per share are very unreliable. This means that these fair values based on earnings here, they are unusable. Maybe you might use these fair values here based on earnings, but if we have better fair values, then I don't use the worse fair values, so I don't use them. We still have the fair values based on operating cash flow and on dividends. And here you see that sometimes the stock was overvalued, like here in 2007 before the financial crisis. After the financial crisis was undervalued, then it was fairly valued for a certain time from 2011 till 2015 about. Then the phase of overvaluation 2015, 2016. Then phase of undervaluation, which culminated in the end of 2018. Now the stock recovered, got closer back to its fair value, but it's still slightly undervalued. Let's examine the current situation a little bit closer. Current stock price is $36, and the fair value at the end of based on the expected result of the current business year is $39. So it's slight undervaluation. Fair value based on dividends is $38, 45. But then we see here that the operating cash flows are expected to decrease, which means that we should better use these lower fair values to get an idea where the stock price is heading. So what to expect? Maybe you might expect till the end of next year stock price of about 37.73 based on this one, which would be or give you an annual yield of close to 9%. And because the operating cash flow isn't expected to move from here to here or to increase, then we should take even better this price point here, because to simulate a sideways movement, and then the annual yield decreases to 7.5%. About 2/3 is are dividends and 1/3 are capital gains. We can also add the valuation lines here to find some other points we could use. So this is my smartphone. Sorry, that's maybe an important call. Thorsten Thiel, guten Tag. Hi. Ja, das wäre toll.
Der Monteur hat mich gerade angerufen, der wäre so gegen 14 Uhr bei Ihnen.
Das klappt. Soll einfach vorbeikommen.
Okay.
Vielen Dank. Tschüss. Sorry. Okay. Basically, that's it. I showed you some stocks and tried to give you an idea how to calculate the fair value of these stocks, and then how to simulate a stock purchase. You can also change the amount of the stock purchase here to get an idea about the total return to expect over the next years. Okay, thanks for watching. I hope you liked, and then just give it a try it out. You even don't need to register. You can either try it out here in the screener itself, or it's also available here in the section Undervalued Stocks. Here, they're just the chart. It's a little bit small, but basically it's exactly the same. Okay, see you next time when downloading the next video. I don't know when. We'll see. Bye bye.